We're going live. We're going live.
Streaming.
We're going live. Oh,
I like hearing on everyone's.
We're going live. Okay.
It's gonna keep going. Whoever is not muted their YouTube needs to mute their YouTube.
just did.
Hey, Huddle.
Live.
I like hearing on everyone's.
Dun, 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 dun. Okay. We'll do our usual wait till 105 to get rocking. Looks like we've got the 7 of us. No, someone even in the chat isn't watching yet. Okay, let's get this thing going, even though it's not a ton of people. It's a good exercise for us anyways. Okay, sharing my screen. Get that out of the way. Pull you down here. Okay, cool. Welcome to our 3rd weekly governance call. What a journey it has been. Start out as we usually do with introductions. And just to give a little bit of context for this call, we've got an open Zoom link that people are able to join. Just want to make it like a little bit more discussion based, particularly around some of our upcoming roadmap items. So we'll kind of start off with just a quick run through of all that's kind of happened and been worked on in the past week, what we have on the docket, and then go a little bit deeper into some of the roadmap agenda items. So as a brief introduction, I'm Trent. I do, a bunch of stuff on YAM. None of it very technical, but I'm super happy to be here. We can just kind of popcorn around the room. Whoever wants to jump on with an intro, feel free.
Sure. I'm Brock. I'm Trent's brother. I'm the basically lead dev on most of the smart contract things. Yeah, that's been my role.
Yeah, I guess I'll chime in. I'm Nate, helping out Brock with smart contracts. Just doing part-time at the moment, but hoping to ramp up my time allocation to this in the near future.
I'm Chris, just a contributing strategist, helping out wherever I can.
Hi, YAM fam, Fedis here. I'm assisting with the investment side of the treasury arm, and I've got some updates for you a little bit later. Thanks.
I am Mick Hagan. I am a contributing strategist. Just doing what I can to help the YAM fam.
I'm Top V3, also a contributing strategist. Currently working on Rage Quit and Rage Quit Lending, and looking forward to contributing, collaborating wherever I can to help push the project forward.
Heck yeah. Cool. Well, I think we have some really fun stuff to talk about today, but we'll get into some of that later. There's been some really cool progress that's been made in this past week, stuff I'm really excited about. But first, we'll just start off with some smart contract development updates. Brock, you want to just run through these real quick?
Yeah, I'll keep it relatively brief. On the ETHM plus liquidity provider voting, all of that code is good to go. It's been audited. Any of the issues have been fixed up. We are just basically waiting on a few snapshot votes to determine basically if we're going to be farming sushi with our deposited sushi liquidity providing tokens. And once that gets firmed up, it'll be pushed on chain. On the contributor governance development, I think it would be best if Nate hopped in, discussed what he's been doing there. But I'll touch on protection protocol real quick. Did some development there, and then Trent and I had a little bit of a breakthrough that we'll talk a little bit about later that could really differentiate us there regarding, instead of doing NFTs for coverage, doing a fungible ERC20 for that, which was really, really awesome. Excited to talk more about that later. Nate, you want to hop in on the contributor governance?
Yeah. So I've been working on the kind of vesting EAM pool to pay contributors. That's been wrapped up. Brock has reviewed it, hoping to move that on chain shortly. Then also with that, we'll be deploying a new governor that has a longer queue and lower quorum requirements, basically so that we can be more nimble and less people actually have to vote. But then the main governance will have, kind of final control over this to override any actions this lower quorum governor has. Yeah.
Excellent. Yeah, so when we get to the upcoming in governance section, you'll see that we've got a lot of stuff that we're ready to move on chain. So it'll be really exciting to get some of those updates going on. But to look at what we've done in the past week, we completed our DPI set purchase on chain. So the first DAO OTC deal was very exciting. Grapefruit was great to work with, yeah, I think they're someone that we're going to be able to partner with again in the future, potentially with this upcoming 250K worth of ETH purchase that we have going. And it's also just interesting because this is one of the spaces in which, we can kind of be building this infrastructure that potentially other DAOs can use in the future. I think, we're really on the vanguard of needing to execute everything on chain. But I think as DAOs continue to need more and more decentralization in the future, because we know that they're not exactly truly decentralized now with multi-sigs and whatnot, more and more of this kind of infrastructure is going to be needed. So it's something to really keep an eye on in terms of like the infrastructure that we're building, and potentially are there things that we can productize out of that? Are we just contributing to the open source ecosystem? And how can we kind of promote that, those contributions, things like that. So I think this was a cool first step in some of those directions. We had a snapshot vote to switch the treasury purchase from Uniswap to SushiSwap that recently passed on chain. And in a similar vein, we passed a proposal to incentivize liquidity with 5,000 balance of underlying yams per week. This one was a pretty close vote. I think one of the reasons, based on some of the conversations that I had with people about why it was so close, is that I think there was some miscommunication around like where these liquidity incentives were going to go, whether they're on SushiSwap or Uniswap. I think some people thought that they were on Uniswap, but we were also voting to switch the treasury purchase to SushiSwap. Just to clear that up, we will be incentivizing liquidity wherever we're making our purchase. So since SushiSwap was passed, that's where those 5,000 balance of underlying yams are going to be going. Any questions on that? And then the other thing that passed this week on Snapshot was this 250K worth of ETH purchase. This is really kind of part one, or I guess part two of a part three proposal to farm index with DPI ETH. I think that's at like 50% APY currently, gets us index tokens. And so that'll also be kind of an interesting discussion around going forward, what we do with tokens that we do end up farming. I think that'll be a good conversation to have. I'm also just gonna zoom in a little bit here. Yeah, so that was the past week in governance. I think we've kind of set the stage for a big on-chain week in the next coming days. So I'll just run through kind of what those look like. We've got the ETM treasury purchase LP governance, as Brock mentioned. That's been audited. And then that's kind of like the big push. It touches pretty much every contract in our system. And then, the liquidity incentives, the treasury purchase source, those are kind of two pieces that really end up kind of attached to this broader proposal, as well as potentially the YAM ETH SLP in incentivizer farming sushi for the treasury, which is currently live on Snapshot. So those are kind of the liquidity incentives where we're purchasing, and this farming of sushi are all kind of levers that are attached to this broader system upgrade that we're going to be pushing on chain. So it's going to be exciting. It's a pretty large revamp, and I think it's going to have a lot of benefits for the protocol. As we mentioned, we've got this 250K worth of ETH that we need to move to an on-chain vote. That really just requires a little bit of collaboration with Grapefruit Trading. Make sure that we're, making that trade available during their working hours and things like that. And given our timing, so that'll probably happen early next week. As Nate was mentioning, we've got this vesting pool pretty much ready to go in terms of the smart contract development. So we'll likely be batching these two compensation related proposals together. The retroactive compensation is ready to move on chain. We have all the addresses verified and things of that nature. So I think that's going to be just kind of a nice bookend to that phase of YAM's life. And now we can kind of be a little bit more forward looking in how we're building this team and being a little bit more deliberate there. So those are kind of all of our current on-chain plans. As mentioned from Snapshot, we've got this DPI ETH index farming, the YAM ETH farm sushi for the treasury. Those are pretty straightforward and up for a vote currently. And then the last thing in kind of upcoming governance, this is hasn't really been developed, but I think once we start talking about the rage quit and lending, it'll become clear why we do need to start addressing this at some point, is that once we have this kind of rage quit pool, that it's up for grabs, I think we're also going to need another kind of pool of funds that we are using specifically for organizational budgeting and whether that's new product liquidity bootstrapping, maybe we underwrite some of our upcoming YCP pools, whether that's paying contributors, just having a portion of the funds that we say this is specifically for development budgets and is not really intended for rage quit. Of course, that would be something where we'd set aside those funds, and if token holders wanted to go reappropriate, move them somewhere else, that would obviously be something that token holders could do, but kind of from the specific rage quit function, kind of setting those aside in the same way that we're setting the contributor vesting pool aside. And I think that pretty much covers the nitty gritty of what's happened in the past week and kind of what we're looking to accomplish from a governance perspective in the next week. Anybody have questions or concerns on any of that?
I have a question about the incentivizer, not the incentivizer, getting the farming the DPI. How long is it going to take for the snapshot to like get the index vote and then go on chain? Because it seems like it would be great if we could sort of queue that up pretty close behind the buying of the ETH.
Yeah, so that is currently, it's passing handily on Snapshot due to end tomorrow morning. And so basically, as soon as we have this passed, as soon as we make the 250K ETH purchase with Grapefruit next week, we then will pretty much be able to go straight on chain with the proposal to, provide that liquidity on Uniswap and stake it in the index farming contract. So I would imagine that, those will be able to happen in pretty quick succession. Chance we get it all done next week. Though there is a thing where a single address can only have one active proposal out. So given how much on-chain governance we have to get accomplished in the next week, we may need to start getting various people the delegated votes in order for them to be able to go make a proposal. So we can coordinate with Brock and Nate on that. I think they're the most capable of making those proposals, and just rallying some various delegation around that is probably the easiest way to go about it.
Okay, yeah, there's only 1 month basically left, I think, on the index farming. So
yeah, when does it? Do you know that
I think it was 60 days from the 8th of October. So probably right around beginning of December will be when it ends.
The end of it, yeah. Okay, so I knew that there was an end date, so we will want to get that done next week, so that we can get those rewards. Yeah, I don't think that should be a problem in any way. And who knows? Hopefully the index folks decide to continue incentivizing that liquidity. I think there's a decent chance of that. But yeah, definitely a good thing to keep in mind and discussion to keep happening. Cool. Should we get into the fun stuff? Any more questions up here?
Let's do it.
Okay, so if you're on the doc, you can check out the roadmap right here. It has kind of a more detailed explanation of all these various pieces and kind of how we're thinking about them. But I'll really just kind of, I think most people are probably familiar with all of these discussions that we're having. So I think one of the biggest things that we're developing right now and that I'm pretty excited about is the rage quit and lending that Tott's been ideating on. So I'll turn it over to Tott to kind of give us a little bit more detail on that high level overview, and then we can have any discussion and answer any questions on that piece.
Right. So I think most of us are familiar with the idea behind rage quit, which is to create a price floor for YAM based on book value and provide liquidity to those who wish to exit the YAM ecosystem. So to do this, we have to segment a portion of the treasury. so that some amount of funds will always be available for use from rage quitting, and also so that funds in use in other areas are not susceptible to rage quitting. I've been referring to this segment of the Treasury as the rage quit pool. Trent has suggested the term liquid book value, which has a nice ring to it and conveys the idea that this is a portion of the Treasury that is always kept liquid and available for use in rage quitting. And so with that, we have a pool of funds sitting idle, awaiting rage quitters, which is nice, but not very productive. And so this is where rage quit lending comes in. In rage quit lending, users can use their YAM as collateral and borrow funds from the rage quit pool. And this allows YAM holders to maintain their exposure while also accessing some of the value of the rage quit pool. So I think that the immediate question that most people have is, how do we maintain liquidity if funds are being lent? And the answer to that is interest rates. And the simplest way to put it is, as funds for rage quit are used, interest rates will rise, loans will be closed, which will free up funds for rage quitting, at which point interest rates will fall again. And so that's the basic overview. Looking forward, the next steps will be to simplify the design to the bare essentials so that we can ship the product. Then we can continue to iterate from there and add features as we go. I hope to have additional resources available soon to sort of illustrate some of this stuff, and I'm happy to answer any questions.
So one question from me, Todd, with the YAM that is being staked as collateral basically for this lending, is that YAM just sitting in the Treasury now? Like, so the Treasury is holding YAM. Is the Treasury doing something with that YAM? Or, I assume it just needs to be available so users who redeem it by paying off their loan can, recover it. But any thoughts as to like what's happening with those tokens?
So in the beginning, I don't think that it would be really viable to do anything with that YAM. I think in the future, something could be done with it. But I think for a first release, I think that we should not really anticipate that being a part of it.
Yeah, agreed. And it also brings up, when a liquidation event occurs and the Treasury basically repossesses that YAM, right? Where exactly does that YAM end up going? Our current structure is like basically when there's YAM in the Treasury and a positive rebase happens, we sell that YAM immediately. But I think in this case, it might make sense to actually start to hold that YAM in some capacity. And there's a great article by Placeholder, which is a VC firm deep in the DeFi space, that talks about how to set up a balancer pool, a kind of smart balancer pool with a buyback model as opposed to a burn model. And so I think that there's a way in which we can potentially start to push that YAM that's repossessed potentially into that balancer pool as a way to, it's kind of a secondary way to manage our YAM inventory and treasury, and do that in a really smart and cool way that I don't think anyone is actually really doing yet, but the idea is out there. It would be cool if we went and executed on it.
Yeah.
So are we thinking anything about the fact that the Treasury will hold multiple assets and how, like, which one will get borrowed or different interest rates?
Yeah. Whose question was that?
Huddled one.
Okay. So at the moment, we haven't quite solved that yet. I think Brock had mentioned that we'll need multiple TWAPs for each asset. I think something that I've had in mind is potentially some sort of manual update. It would be more static. But
So-
go ahead.
One of the things I was thinking about is there's a couple ways we could go about this, right? So we have our, I would say, let's say we're designating 30% of the treasury to this rage quit or the liquid book value pool. One thing we could do is just say, all right, we're going to match whatever assets we have under control of the treasury. 30% of every single asset goes into the liquid book value pool. And so then when you want to rage quit, you're just forced to get, X number of assets, whatever is being held by the treasury, and you just get your proportion of each of those. It ignores any of the,
So just to jump in here for 2 seconds, I don't know how much we could tie into Balancer, but just as sort of a thinking about it out loud, Balancer's smart order routing will let you, when you're joining a pool, pick a single asset to join with. I'm wondering if we could do something similar to the opposite, where you basically create an order of whatever your rage quit is or whatever your lend is, and you pick a given asset that you want to exit with. So you come out with a single asset. Now it's easy to say. I don't know how easy it is.
Are you saying 1-to-1 essentially? So even if the pool has multiple assets, it's still, I put in YAM and I get the specific asset I want out.
So say you've got this the book value, and I'll just simplify it. You get 10% DPI and 90% ETH or something like that, or whatever, 90% YUSD, and you want to exit as all ETH. So then you would basically have a smart order routing to exit as a given thing that you want. I guess realistically that would be at somewhere between the treasury and the UI level. It would be a smart order routing trade. Now the hard part is when you're borrowing it, I'm not sure how you do. I guess we would end up with I think we almost have to end up with a single interest rate. I think otherwise you've got a curve on every asset that we hold for a different interest rate for a different asset. Because say you've got 100 YAM, you want to borrow only ETH. That kind of puts the treasury on the short side of that trade, right? So you kind of have to say, no, you can't only borrow ETH. You have to take whatever we give you, and then you can sell it, and then you can do whatever you want.
Yeah. One thing that we can do to ship this quicker is just say, all right, initially even though we'll have like potentially YUSD, Sushi, Index, ETH, and DPI all in our treasury, we could say initially only YUSD is available for that's going to be put in there, just to simplify it, and then we can iterate on it later.
Yeah, and this is what I'm saying with the liquid book value. It's like we can basically say, hey, our Sushi holdings and our Index holdings and our ETH holdings, DPI, those are in like kind of the portfolio pool that are actually like our investments. And so if you want access to those, you've kind of got to just hold YAM, or YAM token holder governance has to move it around. But I think for this first iteration, as Brock's saying, it's like, let's just put just YUSD as the way to lend or rage quit. And like however much YUSD that we put in there, that's our current liquid book value that people can get access to. And I do really like the idea of like, we have YUSD, but maybe you really want to receive USDC or DAI or ETH, like similar to Zapperfy, we could have a mechanism on that withdrawal process to say, how do I want this YUSD, processed for me, essentially. But yeah,
Yeah.
that's
I think
kind
that's
of
great.
I have another thought, and Fettis and Krugman, feel free to yell at me. But what if we used the token set, so the asset itself that represents our investment arm of the Treasury, as the rage quit asset? So we just allow people to rage quit, from the Treasury, basically, from the investment arm.
So that's not a bad idea, I think, but it also depends on, I guess, how much of the treasury we plan on putting into the token set. So
That's
yeah.
true. Yep.
The other thing that we should be considering is just how much people would want to use a loan system that's denominated in USD versus in a bunch of crypto assets, because
Right.
someone taking out loans has a very different outlook if they're borrowing dollars versus if they're borrowing Ether. So
Good point. Yeah,
it
that's true.
changes everything. I think it's kind of an interesting idea, but it maybe works better for rage quit than it does for lending. So how do you balance that is sort of a big question.
And they don't have to be feature parity, right? Like rage quit can have different functionality than lending, and I think that's totally fine in general.
So I think that's a big question, because lending has kind of been brought up in a bunch of different ways by different folks, as has rage quit, right, in different iterations. And I think right now, Todd, correct me if I'm wrong, but a lot of your work in this initially has been sort of a almost like an MVP for lending, sort of piggybacking off of rage quit, sort of building the two together so that, lending provides essentially a smooth off ramp for those who want it, because they're basically just choosing not to repay their loan. I agree, Brock, we can definitely split the two, and that may be what we need to do. But it is a pretty fundamental question, like, are we going to treat them as essentially separate products or separate?
Yeah.
In the current design, they are mostly separate.
Yeah, I just wanted to kind of piggyback off that topic. One of the concerns I have is that, well, first of all, thank you, Todd, for all the great work that you've already done here. So this is not a criticism of any of the work that you've done, but related to what I think Chris was just saying around, I'm worried that we're trying to kind of fit two things into one, and then we're not going to do a great job at either one of them. From a capital efficiency standpoint, as I think about my YAM and how I'd love to get the most use of my YAM, I would rather use something like Cream or Aave or Compound. Now I know that YAM's not supported on those yet. I hope that soon enough we will be. And at that point, at that point, a Mainframe, for example, which I'm connected to, but at that point, this just isn't efficient use of my capital in terms of my YAM collateral.
Sure.
And so if the rage quit value is just a fraction of the treasury, which is a fraction of the market cap,
right,
I'm just not getting very much loan to value ratio on my YAM.
Sure.
So that's one of the fundamental issues that I see.
Right. So a couple of things for that. The amount that you can borrow, given your collateral, can be relatively high. It doesn't need to be 30%. It doesn't need to be it doesn't need to be proportional to the size of the pool. Two, I think that with this, I think we can offer better rates than you would get at Cream, and as you say, YAM isn't even offered at Cream at the moment. But even in the long term, I think we can offer better rates. Does that help?
Yeah, but it's not just about rates. I mean, rates are certainly part of it. But it's just, how can I get the most value? How can I get the most loan to value ratio for the value of my YAM? And right now, that value is far bigger than what we're talking about of like a percentage of the treasury, which is a percentage of the market cap. So the value of my YAM is much greater than the value of like what I would be able to borrow in a system like this.
Yeah, I think one of the things though is that we really have seen extremely little to no adoption of rebasing assets on any lending platforms. So, I mean, yeah, in terms of if that starts happening, I think that the value prop goes down considerably. But I also don't think that it's that heavy of a lift to implement this, and it does then make YAM one of the very few rebasing assets that you can use as collateral anywhere.
Yeah. Well, so here's what I was going to say. In addition to what I was just saying, why don't we think a little bit bigger? Because right now, what I'm concerned about is this is just a tool. It's just a product for YAM holders. Why don't we build a money market, a compound-esque tool where YAM is one of the collateral assets, where the DPI and basically our treasury and YAM are the assets supported by this money market. And so if somebody wants to borrow USD, great. Somebody wants to borrow ETH, great. Any of our supported assets, and YAM can be one of the collateral assets. So instead of limiting it in scope to just YAM is the only lend asset and YUSD is the only borrow asset, why not just do a compound-esque money market and anybody can participate, whether you're a YAM holder or not. And our treasury is just kind of one of the lenders. It's one of the bootstrapping liquidity, but it's not limited to just the treasury or YAM holders.
Right. So the way that I've thought about this is that this is basically it's just a system where the treasury and YAM holders are the counterparties, right? And so this could kind of serve as the building blocks for the kind of system like you're talking about, where we could bring in all different counterparties, right? Does that make sense?
Yeah, I think if that's the vision or that's the path, then I'm all for MVPs. I'm all for like version 1s, and then we work towards that. But I don't know that we're all on the same page of like that would be a path that we'd work towards. Because I think the product that we're talking about, connecting RageQuit, I mean, RageQuit is very connected to YAM token holders. And so if that's one of the major constraints, then it doesn't align with kind of like a bigger money market that anybody can participate in.
Yeah, Mick, I'm with you. I think this is, I'm fully on board with broadening the scope of the money market because, and just in general, these ideas of we can act as this large counterparty because we have this big treasury and capitalizing on that. And I know you're saying we can expand that, but yeah, basically all I'm saying is I agree. I think what Todd has laid out is a very good stepping stone towards that. And I think, once we add one asset, it'll be designed in such a way where we should, in theory, be able to add other assets later on.
I guess the distinction would be if the value of your YAM is greater than the value that you can rage quit with, then we should take that value. Like we shouldn't reduce the value of your collateral. We should take the greater value between your rage quittable value and the value of your YAM, whatever the loan to value ratio we decide on that. Whatever the greater value of that is what your kind of borrowing power would be in using compound lingo. I don't think we should limit it to just the rage quit value, because if anybody else takes YAM as collateral, chances are you're going to get greater capital efficiency by putting your YAM elsewhere.
Do we think there's a risk of, I mean, obviously right now looking at the market, we're far from this issue, but I mean, is there a risk of, in the same way that, the treasury becomes a floor, value for YAM, that it could also become like an upward ceiling for YAM if, kind of preventing it from exceeding the value of, its value as a borrowable or a collateral asset, I guess, in a rage quit scenario. Does that make any sense whatsoever?
Yeah, it makes sense. I'm not sure. I've thought about the same, but what I would be afraid of is that if the market value of the rage quit exceeds the value of YAM, then we would have people quitting and essentially burning their YAM and burning the treasury at the same time until I assume that they would reach parity. But again, it would totally depend on the design.
But I think we would use the greater value, right? Like if you're a YAM holder and you deposit into this money market, we'll give you the borrowing power of whatever is the greater value between those.
So I've been thinking a bit about potentially making it so there's another curve that is based on the rage quit value. That if it did become a money market, and then lending YAM, you would actually get a rate discount based on the amount of like your share of whatever's in the rage quit. So it sort of gives an added bonus to people who are using YAM as collateral, because we can then use sort of their rage quit value as like additional like counterparty funds.
I think that's a great idea. Yeah, I think that's a great idea. And I also think YAM should not be a borrowable asset.
No shorting.
Exactly.
So
if
that I
YAM's not a
understand that.
borrowable asset, if YAM's not a borrowable asset, and we did something like what Ross was saying, that's buy pressure on YAM. Buy pressure on YAM. You got to get those rate discounts.
Just understanding quickly, is what Ross saying, say you have $100 worth of YAM and you've got $30 worth of rage quit value, does that mean you've got 130 collateral?
Either, I mean, the way that I've been thinking about it would be that there's a curve that is related maybe to utilization or something, that because not everyone is going to be able to use, the rage quit value is limited. So really it's more of like a discount. So if you are borrowing $10,000, but your rage quit value is $1,000, your actual amount that you'd be paying interest on is the rage quit value times some multiplier. But let's just say it's 100%, that would be $1,000. So you'd only be paying interest on $9,000 instead of $10,000, because basically the treasury is providing that it's free, it's interest free on whatever your rage quit value is, and then the rest you pay the full rate. Or some multiplier probably needs, because otherwise you could like just borrow the rage quit amount and now you're at zero, and then that money gets stuck there forever and there's no reason to actually rage quit.
I think it's a discount on the rates, Hodl Dwan. It wouldn't be additional borrowing power. I mean, I guess in a roundabout way it is, but it's more of just like a discount on the interest rates.
Yeah. So in general, like, I don't think we've been great at communicating that there is a larger vision here. And so I'm glad that you brought it up, because I think it's important to start like building that larger vision into the design now. And maybe it's worth it to kind of push it further from the get-go. I think there's some benefits and then some drawbacks in terms of like time to production and whatnot. But I think there's a lot more to think about here. I want to make sure we get to the product protection protocol and treasury discussions. Yeah, but I think this was super, super productive. Todd, do you have any kind of closing thoughts on potentially expanding this in the short term versus the long term?
I mean, I think all the feedback's great. The larger vision of a compound like money market is definitely something that interests me. So looking forward to contributing where I can there.
Can I just say if anyone is watching who is a developer and has an interest in the lending side and like any kind of lending product, this is an area that we're going to need help with, because especially if we were to pursue more of a compound-esque money market, that's a lot of work. Brock and company are already fairly preoccupied with the YCP product, which we're about to jump into. So if this is an interest you have specifically, go to the volunteer channel, let us know, identify that for us, and maybe we can start laying down the foundation for this.
Absolutely. Okay, Brock.
But I just want to say great
Yeah.
work, Todd, on leading the conversation and leading the ideas around this. So thank you very much.
Agreed.
Cool.
Brock.
Yeah, I'll hop into YCP. So a little bit of an update. So I got probably 80% of the way through the latest spec, and Trent and I had been bouncing around trying to think like, okay, NFTs for coverage are okay, but there's almost no secondary markets for NFTs. They're difficult to trade. Honestly, I'm an avid DeFi user, and I've touched maybe 2 NFTs in my experience, and I use DeFi all the time. So that got Trent and I thinking, okay, how can we make this protection, this coverage, an ERC20 as opposed to an NFT, basically from non-fungible to fungible, to make it easily tradable on Uniswap or wherever. That led us down a couple paths, and we had been bouncing around ideas around, okay, what if it was some sort of rebasing token and this and that. But really what we figured out is effectively the technical constraints are when you open a position, a coverage, you have certain parameters that only apply to you, namely the duration and when you actually bought it, right? And so that's what makes it an NFT, is that it only applies to you. That there's a very specific start date and a very specific end date. People get around this in certain circumstances by having a specific end date. And so if you have a specific end date, what that does is that means you can basically at any point mint and buy or sell these tokens because there's a specific end date. But we don't really want to have a specific end date. So what Chung and I have been searching for, and what we think we found, is a way to do a perpetual coverage. So what this means is there is at any point you can, I'll touch on what any point means, but at any point you can mint and you can have coverage indefinitely until your initial deposit runs out. So if I want to buy $100 of coverage, I can at any point buy $100 of coverage, and that coverage will last until basically I pay all of that as interest or premiums. And so the way we do this is we kind of flip it on its head. Instead of saying this is the date it ends, we say, we basically say there are specific times at which you can buy. And so what that does is that says, okay, let's say every 12 hours, we have a settlement. But the settlement is basically for the last 12 hours, there have been purchases and there have been mints and there have been burns of the token. And at the end of that 12 hours, then you can start transferring it to other people. So what that means is, let's say at 12 p.m., a round finishes. Now, if I bought at 11 a.m., I now have an ERC20 for $100 that I can freely trade. And at the end of the next 12 hours, my balance of underlying decreases. So I'm paying some interest to the underwriters, but everyone is synced up, so you can decrease everyone at the same time. I'm probably not explaining this very well, but effectively, if you sync up when people actually get the token, you can decrement everyone like an index, even though they had an individualized position. And so you get this scenario where you have a fungible coverage. Trent, I feel like you should maybe try and clear up what I just said to make it a little less technical and a little bit more straightforward.
Yeah, I think in general that sums it up reasonably well. Basically, you have a coverage token that has a balance of underlying that connects to the amount that you've deposited. And similarly to a perpetual, you are constantly paying a funding rate on that deposited amount. And so as you pay that funding rate for your coverage to the underwriters, your balance of underlying decreases in your coverage token. And so as Brock's saying, one of the reasons it's difficult to do this if you can buy it anytime is because the exact amount of interest that you would have accrued is determined exactly at the time that you bought it. If you essentially do a settlement process every 12 hours, it allows those funding payments to get synced up such that everyone is paying the same amount. And so, yeah, you basically end up with a perpetual coverage that slowly decreases over time through the funding rate. And so this just makes it a lot more tradable and liquid. I think one of the really interesting things about this protocol is in the event of a bug or a hack, all of the funds from the underwriters get paid out to the claim holders. This is very different from most of the other insurance protocols that basically I have to go file a claim for my specific amount of tokens and I get a specific amount of coverage. I get a specific amount covered based on that. In this case, it's a single claim event that occurs and then everyone is paid out. So what that means is that there is potentially a fairly vibrant secondary market for this coverage based on how much is in the underwriter pool, which is the theoretical upside in the event of a hack. So it ends up having some quite interesting secondary market characteristics. Yeah. Okay, any questions on that? Because I know that's probably not super well explained by either of us.
Do people understand? Yeah, go ahead, Chris.
Oh, no, I was just gonna say it sounds great. It sounds really cool.
Cool. And so there would be some sort of funding rate, so determined by utilization. So if I buy $100 of coverage and there's $1,000 of outstanding coverage, or if I put in $100 and there's $1,000 in the protection pool currently, the amount of the funding rate is determined by the outstanding bought coverage versus the underwriter coverage, if that makes sense. And so then at the end of the 12 period, it looks at the utilization, updates the index, and that's how people are. That's how people pay into the index, and so it decrements your balance of underlying.
So we'll write this up with some diagrams and charts that make it a little clearer what's going on here, and kind of spell out some of the benefits. But this is really. Go ahead.
Sorry, just to jump in here. What do you think the user experience is going to be like jumping into one of these pools? Are we going to have a UE like Uniswap, or is this going to be more of a I'm trying to understand the user flow of I want to buy this thing. How do I decide how much it's worth for me to either buy for coverage or to provide liquidity for coverage?
Yeah, so the basic user flow would be to go to the website, deposit an amount of, DAI or ETH or whatever it is, and then, after the settlement period, you would then be able to go receive the tokens that you've purchased, or really staked for. And so then you've got this ERC20 that the balance of underlying is decreasing along with the funding rates. You can either go, you can go supply liquidity for that on Uniswap or something such that other people can buy. I think we need to give a little bit more thought to that dynamic, mainly because it's like, okay, if you're providing liquidity with your coverage token such that people can go buy, and then there is a hack, but it's like pre-claim. It's like people are gonna go buy the heck out of that. So like, are there any restrictions that need to be put on that in some capacity? I think that's the secondary market we need to give a little bit more thought to. But yeah.
Yeah, I feel like you'd have to throw on like maybe a 24-hour or something limit on there. You have to buy coverage the day before or something.
Mm-hmm.
Well, yeah. So in my mind, what could happen is since effectively you can't transfer your newly minted coverage tokens until the start of the next period. So if I buy at 11 a.m. at 12 p.m., if it's every 12 hours, for example, then that's when it becomes transferable. And so let's say I bought at 11 a.m., but there's a hack earlier in the day at 9 a.m. or whatever. We can just stop that round of purchasing. So assuming the arbiter can act within the time frame between, then there should be no issues in my mind. It's still something to work out though. Then there's another question. Double Day Blue on YouTube asks, can anyone explain the difference between YCP and Nexus Mutual? Yes, so there's a number of differences here. First being Nexus Mutual's KYC. This will be no KYC, and you'll be able to, and also we will be offering a ERC20 for the insurance pools. Versus in Nexus, if I buy coverage on Compound, that's not an ERC20 that I can go and sell on the open market. Additionally, Nexus Mutual determines the payout amount. Currently in this system, you are speculating on the whether or not there will be a hack, but also the payout amount is the entirety of the protection pool. So if there is a hack, the entirety of the underwriter's principal is paid out. I hope that that clears up your question. If anyone wants to
and then the last thing I would say is that it's underwritten in ETH or DAI, and that underwriting is specific to the pool, whereas in Nexus, the underwriting is done with the Nexus token, which is backed by this general pool of Ether, but they have a number of kind of complicated solvency concerns that they have to be concerned about. Yeah.
I think it'd probably be worth our time to maybe do like a diagram comparison or something of like, features of Nexus versus YCP, and just so it's clear to people. I know this is a question a lot of people have, so wouldn't hurt.
And that'll be especially good with the number of, there are a couple other insurance protocols coming out. So just like a general diagram of how this will be different than all the others. We're coming up on 2:00, and so I want to make sure that Fedis gets a chance to talk about the Treasury, because this is some of the stuff that I'm really, really excited about. So we can dive back more into the protection protocol, on the tail end of this if we want. But Fedis, do you want to kick us off on some of the Treasury management stuff we have cooking?
Yeah, love to. So I am assisting the YAM team along with Krugman on the Treasury investment arm. We got some really cool updates and some exciting stuff coming up. We have entered into a collaboration with Token Sets. If you guys haven't checked out Token Sets before, it's essentially you can create a set or a fund that's public facing that people can invest in, and then you help manage those funds by depending on what you want to do with that set. So for us, the YAM team, they're coming up with version 2 contracts, which is going to allow us to do a whole different bunch of different functions as far as potentially yield farming, investing in other platforms or like other products. For example, what we're thinking of is, actually, let me back up real quick. So what we currently have is we're buying assets for the treasury and we're just holding them in our treasury fund. What we're planning on moving to is having a more actively managed treasury on Token Sets. By utilizing set protocol, the treasury can retain custody of the funds and continue operating in a decentralized manner, while allowing for more active management via elected individuals with guardrails that remove the necessity to trust the individuals to always act in good faith. So what that will allow us to do is we can set up through our governance kind of what this set manager is supposed to do, and the set manager can go ahead and invest in different areas to build value for the treasury. Krugman has been laying the foundations with SET, developing some of the structure that's needed for YAM to create its own set on Token Sets. And the cool thing is that there are two things that come out of this. Number one is we're eventually going to make this set that we manage public, and other people can invest in it. And when other people invest in the set, there are management fees, and these fees will be funneled to the YAM treasury. So essentially, it can be a product for YAM where we can make fees, and it can continue to grow the treasury. Another thing that we're really excited about is as we build the infrastructure at SET, we're going to be introducing possibly some YAM products. For example, the YAM crop protection we can build into Token Sets, which will allow Token Sets to offer YCP into their other Token Sets on their platform, which will generate more value for us. Any questions at the moment? I think I kind of went over that too quickly.
Yeah, I mean, for me, I think that the main thing that I'm really excited about for this is just the way in which it allows us to have much more flexibility with our treasury and our fund management without any sacrifices to decentralization. Right now it's like if we want to do anything with the treasury, it's this like 2.5 day long process, and it's just like can be kind of a nightmare. With the SET collab, we're going to be able to say, all right, here are the funds that we want to have actively managed, and then utilize a lot of the risk analysis and beta correlations and all of that FEDUS is working on, and be able to act just much quicker. And so this is again one of these areas where it feels like we're laying the groundwork for how DAOs can like operate and be efficient in the future. The SET team is really excited that we're taking this on with them, and it's one of the use cases that they like have absolutely been working towards in the long term. And so it's really cool that we're going to be the first ones to start using them for this kind of like treasury management type system. So it's extremely
yes. So we also I put up a roadmap on our forum. So in case you want to get more of the details about what's going to happen and what we're planning on working on. Right now, we're in process of building out the set before we can actually invest funds in it. So it's a work in progress, but it's moving along very quickly. Krugman is spearheading the building of the set right now, and also the management of the risk is going to be much more flexible. Instead of like Trent said about the governance does take a little bit of time.
So that's a question I had, I guess, about like managing the set, making sure it's balanced correctly, all of that kind of thing. You know, I assume we're going to need someone to do that. And is that going to be a position, I guess, that governance is going to have to vote on essentially? And how do you see that process moving forward with our governance structure?
Yeah.
So go ahead, Trent.
I think we're probably going to have like potentially 2 people working on this. One that's taking a 30,000 foot view of the treasury and getting in the weeds, but like really figuring out kind of like what we want to be doing with our funds and getting, you know, writing weekly, monthly investment memos and keeping everybody up to date in terms of, you know, where the investments are and kind of how those risk profiles are doing and all of that stuff. And then we'll likely have someone who's actually like actively managing the set based on those risk parameters and based on those, you know, governance proposals that the, you know, the general treasury manager is giving to the community. So the community is still going to very much be the ones who are driving the strategy in terms of giving sign off on, you know, a more conservative versus a more aggressive portfolio, you know, where are the type of farming opportunities that we feel comfortable getting into. So it's still going to be largely community driven. There are just going to be 1 or 2 point people who are actually kind of doing the consistent analysis and doing the consistent execution.
Yeah, so basically governance is going to be establishing like a proxy on their behalf, to manage it on their behalf.
Yeah.
And I only bring it up just because, you know, I'm sure that job in and of itself, I mean, we're really talking about 2 jobs, right? We're talking about the active management of it, and then also the communication of the day-to-day management, or boiling that down into just, you know, concise, you know, or concise, understandable, you know, material that the community can, you know, parse and vote on, or, you know, make adjustments based on. And so essentially communications. And both of those are going to take time, and likely the people doing that are going to need some kind of compensation, either through our vesting structure or, you know, retroactively. So I just want to make sure that, you know, the community knows like, hey, that's probably going to come up at some point. You know, and though that, like, you know, we will be gaining value from it, from those people doing those jobs for us. I do think it's important that we make it clear, like, okay, what is the value trade-off here? Where, you know, if we pay someone to do this for us, essentially, how do we, as the YAM community, all benefit? How does the treasury benefit? That sort of thing.
Yeah, 100%. And that's part of why I got that contributor framework structure out last week. I think we're getting to the point where we're going to have a couple people coming on to be full-time contributors, and so having that structure in place of how do we you know, how does that person signal their interest? How do they you know, showcase their experience and why they're a good fit, and how is the position going to add value to the protocol, and, you know, what should we be paying that person?
So YAM fam, if you haven't gone to the forum yet and read Trent's write-up on that structure, please do. It's important. It's not set in stone, obviously. There's still room for feedback, I believe, Trent, but and discussion, but now is the time to discuss. because it is an important part of just all of us being able to move forward and keep making YAM awesome.
Agreed. Cool. I know we've been chatting for a while. Is Nate still on? Want to give us? I know we'll probably kind of skip this part because I know Nate already touched on where we are with the multi-governor compensation structure. We've got the contributor vesting pool pretty much set and ready to go with its new governor. The contributor governor still needs to be developed, but it's basically the same as the contributor vesting pool. So technologically, we're in a really good place to start getting full-time contributors onboarded and ready to go. Again, this contributor framework from an organizational standpoint also gives us puts us in a good place to get some full-time contributors onboarded. So I think these are moves that we're going to be seeing happen really quite soon. And so it's going to be awesome to be growing and consolidating some active full-time contributors. And I think that is most of what we really needed to cover. Definitely down to keep jamming on any questions that people have. I'll give a quick review of the YouTube comments, make sure we got most of the things here. Yeah, any last questions, concerns? Want to talk more about the protection protocol? Anything is fair game.
Quick question, I guess, about the multi-governor contracts and everything. I guess this is also something that we could eventually spin off into like a DAO focused product, just like a framework that other DAOs could use moving forward, right?
Yeah, 100%. And it's really just building off of Compound's existing governor, where basically, we're just deploying another instance of the governor contract, but we're giving it, different quorum requirements, different time delays on everything, and giving it different control over various pieces. So like with the contributor payment governor, that would have control over, this development budget that we establish. And, maybe it can only move at a maximum of, $50,000 every 2 weeks or something like that. So it's basically about trying to find this flexibility between a little bit more agility and less, everyone needs to pay attention to this thing, and more, the people who are really, really actively engaged in what's going on can kind of make those decisions for the broader group.
Yeah, that makes perfect sense and sounds great. Sounds really interesting.
Yeah.
One thing for me, and this is kind of backing up a little bit, but back to sort of the rage quit, and there's tons and tons of stuff to still flesh out there, I think. But I'm still kind of drawn to the idea of I guess there's sort of a bigger question of how is the Treasury going to budget, right? And there's been some really great work in terms of Treasury management, those conversations already. But I think there is sort of a question of rage quit as sort of a budget item in the Treasury's overall budget or a budget pool versus ultimately the issue is we want to make sure that funds in the Treasury are available when we think they should be available for the different use cases of the Treasury. And to me, but then that kind of runs into the issue of how do users then get access to their funds through rage quit, and how much of those funds should be accessible. to me, it seems like the best case scenario is really just that whenever government decides to set aside money for any use case, it should go into a contract that holds it essentially in reserve or in escrow for that use case. And that way Rage Quit could just be whatever, net of that, right? Because if governance hasn't set that aside, then it's still liquid. But
Yeah,
I don't know if that's what you guys are conceiving, or maybe there's some major flaws in that.
Yeah, I think that last that you were talking about is kind of a lot of what the compensation fund holding contracts Trent was just talking about. So it's pretty much just a multi-sig that we send funds to for a specific project, and then the low quorum governance can transfer up to X amount per week or whatever. And then the fast high quorum governance, can override those decisions and kind of have more of an admin role in the contract.
Yeah,
And I definitely agree that we should focus when we're concepting and building these projects. We should really start thinking a bit more about budgeting and actually allocating stuff.
Yeah, and just having I think we have a lot of thoughts about like what the overview of the treasury is and where its funds are and like kind of what roles they're going to play. I don't think we've done a lot of the work to like really create some like percentages and actually start to break those line items out. And so I think we will need to, in the near term, start to really figure out, okay, we have this money in the treasury and we know some of it's going here, some of it's going here, some of it's going here, but what do those numbers actually look like?
Yeah, that makes sense. And I only bring it up, I do think, just because we, right now we have a limited number of products. We're still very, very early stage. But there is a future where we have a lot going on, and and the individuals working on different projects are, there's a lot more diversity of individuals in the group. Everyone's kind of working on their thing, and where maybe there will be overlap, right? Where a lot more of the treasury funds are claimed or spoken for than are currently. And so I think that is going to be important. So we're not, the community knows where everything's at. And I know, there's some work being done already with for the dashboard on the website, just to show and illustrate like how much of the treasury is represented in the DPI set and that sort of thing. I think maybe in the future at some point it might be worth adding, a treasury allocation, like current treasury allocations or budget or something that's, based on like the latest approved budget from, the government's or governance forum or something like that. But yeah, how to manage the budget as a DAO, I think is going to be super important.
Yeah, definitely.
On the Rage Quit, I just think, in my opinion, I don't think the Rage Quit functionality, so specifically like the Rage Quit, not talking about lending and borrowing, all that stuff I think is really cool and should be prioritized. But on the Rage Quit, in my view, it just doesn't seem like it should be a high priority right now, because the treasury value is 2.6 or something. Our market cap is 9, 10, something around there. It only comes to play when it becomes rational for somebody not to just sell their YAM, to exit the entire YAM ecosystem. Right now, the YAM value is way more valuable than the treasury value. So it just doesn't. I worry that if we do that anytime soon, it's just a poor prioritization, because it only comes into play when the market cap is close to the treasury value. And we're talking about earmarking some treasury for projects, so even the treasury the book value, it will even be less. So it just seems like we're not anywhere close to a situation where somebody would actually want to Rage Quit. So I just worry that it's just not a good priority right now.
Yeah, I understand that sentiment. I think you are correct. But when we were coming up with it, the price was heading in a different direction than it is now. So it may have been pertinent.
No, but it was the opposite, right? So now we're actually closer to it being pertinent than we were, a month ago, right? When the treasury was 1 million and the market cap was 150 million, then it's like, all right, this makes no sense. You would just sell, right? It's only when treasury is 50 million and market cap is 50 million, which, to be clear, I don't think that will ever happen, right? Companies generally don't trade. They trade at some multiple of their book value most of the time. It's only in certain scenarios where I can't really picture when this will happen, but I generally agree with the sentiment. It's an interesting. To be honest, it's a little bit of a signaling to YAM holders like this is always there. Like you have ownership over the treasury at the end of the day, and it's not the best demonstration of that, but I understand why people would want it. That's not to say I don't think it's premature to do it right now, because I generally agree. But
Are there a lot of people that are calling for it in the community? Because I don't sense that, but maybe I just am not paying close enough attention.
We've gone through cycles. We've gone through periods where it's basically been everything that anyone is talking about, and then we've gone through periods where no one's talking about it. And it's hard to predict specifically, which cycle we're going to hit at any given point.
It matches up pretty well with the direction price is going at any given time.
Sure.
If we could predict when people are going to beg for it, we could predict the price of YAM.
It's also sort of an easy answer to like, a lot of people are sort of confused as to potentially what the value proposition of YAM is. And it seems to me like that was proposed as an original and easy answer to like, well, what's backing YAM? Why is YAM valuable? And there's a way to just say, well, you could get this, and as the treasury grows, that'll grow as well. It may not be so important if we actually have products that bring in revenue, but there still is a question about how that revenue gets actively returned. How, like, we don't have a dividend, we don't have really anything. So if there's no rage quit, how is there actually a way in which
how does the average YAM holder benefit from YCP and from any other product that we come up with? That's a question that continues to come up in the Discord forum.
The other thing is that token holders could always vote to distribute the treasury to themselves, right? You don't actually need a rage quit function. You can always just right.
But the difference between rage quit and voting the treasury funds distributed is who do they get distributed to? And the top holders will distribute it to the top 10 or something like that. They can.
Yeah.
I think there is something to be said about programmatically allowing an exit, for people, versus sort of encouraging governance to, hey, if you're feeling antsy, like we could pass through like a massive exit, right? And I think that's not necessarily beneficial to, long-term endeavors. But
so, here's an idea. Maybe we use we build rage quit with the intention of it being a mechanism to also distribute to do distributions if it comes to that point, right? Like if you're holding any other, I'm not going to say the word, but they do distributions. If you are a and maybe we can come at it from that angle where it's because that will be a thing that we do eventually, in my mind, where Treasury is crushing it. It does some portion, some distribution that you can claim, and so on and so forth. It might be a good mechanism for that.
It's all, the fact of the matter is Mick is exactly right that it's not super useful, and likely won't be in the future. But that's why I really like the rage quit lending, because it ticks off this box of, okay, like theoretically you can go rage quit if that ever becomes a thing. And it's like, likely if you ever needed to rage quit, like we would not, it would be like, oh, holy shit, we need to rage quit. Not like oh, it looks like we're going to need to rage quit. I guess we should build that product and then release it in, 2 months.
Yeah.
So, like, I think it's a good box to check, but on its own, I don't think it's like it's really, it adds any value. Whereas
Yeah, it's just not rational to rage quit, and I don't see it ever being rational. But it's certainly not rational right now, or in the next few months. I mean, we'd have to have a huge price hit.
yeah,
You could also
it
think of it
was
as an
a,
emergency shutdown in a way, right?
That's
Like if something happens and like we're unable to vote, or the DAO is unable to like do something, and the price crashes, but the treasury is still there, like this is a way that money doesn't get stranded or something like that, in that anyone can go in and they can rage quit with the yams that they have and get out.
I think
Not-
there's, depending on how it's executed, I think there might be some benefits, but again, it really just depends on on the details, right? So like Mick, you brought up, well, why wouldn't someone just market sell their yam? Because right now they'd get more than rage quitting. And like, that's true, but depending on what the treasury then does with that yam that's being traded in, do we want people dumping their yam on the liquidity pools, or maybe the treasury is holding it, right? So it doesn't impact the price in the same way. So those kind of things might be beneficial, or might not. I'm just putting it out there.
Yeah.
So-
And just to be clear, I'm not saying that there's no value in rage quit. For me, it's just a question of priority. Would we rather have Brock and whoever, Nate, working on new products, new innovation, new things that will inspire the community and bring new people into the community, or something that's just like negative, that has no purpose right now, could have purpose in the future, but no real purpose, right now or anytime soon, as I see it.
So Mick, so the way that I've seen it is that it was an answer to a lot of people's question as why the treasury gets 10% of the positive rebases. And every time there's a positive rebase, somebody always comes up and is complaining about why is the treasury getting the part of the dilution. So it was
negative rebase.
Yeah.
They still have the same question.
Yeah, and then why is it not going down when there's a negative rebase? So I think it provides a value to the community. It's a nice kind of a gesture. Obviously we don't want it to be used. We don't plan on having it used, but it's like a buyer of last resort. If anything happens, it's still there.
I think to speak to your question about the priority, Mick, I do think a lot of the rage quit discussion was originally driven by, where we were at a month and a half ago, when it was like the big thing that everyone was talking about. And it does speak to just how long it takes just to develop things, right? We have a limited team at the moment. And so at this point, I think you're right. It probably isn't the biggest priority. When it was first brought up, it felt like a huge priority, at least to me, and I think probably to a few others. And for those watching this, I think it just goes to show how quickly priorities can change, and honestly that they should change, and we should be reevaluating them as the nature of things adjust.
So I think it's not rational to use rage quit right now, but it could be at some point in the future. And it's kind of one of those features that you want to have, because if you have it, you should never have to use it. So it is more like a global shutdown from MakerDAO or something, right? It basically gives you a price floor, something that you can say, all right, now it's rational to rebuy because it's definitely the bottom of the market because we have this rage quit function.
Yeah, I think one of the and I don't disagree with any of the ideas of why it could be valuable. But when we start getting into the details and the nuance, it's like, well, we got to earmark this for budget here, earmark that, maybe we're doing like VC seed style investments. It starts getting really complicated. And the scope of rage quit for a nice to have feel good thing, all of a sudden is like, okay, let's reevaluate first principles. Like if it's going to be complicated and take a lot of time and energy and resources to figure this out, should we really be doing it?
Yeah, I mean, I would say if rage quit is going to get built in, it should be simple, and it should be something that's really easily understood and something that the community, those who feel the need to do so can pull the trigger on pretty easily. I think in the grand scheme of things, yeah, we're probably overcomplicating it. I do think it'd be worth, like, maybe in the Discord or the forums, if the community wants to chime in on, pros and cons, and maybe we can consolidate all of that into one space. Just so it'd be a little, we can have a little bit more guidance too, and kind of reevaluate better, because I think this is something also the community just really needs to weigh in on and tell us, like, hey, what do you really want here? Because I mean, I think most of us would agree. I think there are probably more productive and more profitable products that we could be putting our efforts into. But the community, kind of needs to signal to us, do you agree? Do you concur?
So the only thing that I would say is that I think it's fine to have it, but I agree that it needs to be simple. I don't know that, like, I think doing the rage quit and or mixing it with the lending, I think that definitely complicates it. I don't think it's so complicated if we have, if we separate out assets that are getting managed versus, because if they're all ERC20s, then we can just split the treasury for the rage quit in the correct proportions. I don't think that is too complicated, and at the end of the day, you get what you get. You just get a share of everything, like an index fund. But if we've already spent time on it, I'd like to get it finished and then move on to the next. Like, keep it simple, get it finished, move on to the next product. And because we are constrained on devs, I wouldn't want to keep, even if it's lower priority now and it was high priority last month, let's just get it done, move on to the next one, then we don't have to think about it anymore.
Yeah, I mean, the only no code has been written, so like it's largely been Todd who's been thinking about this stuff. And the only reason I'm excited about it is specifically for the lending capacity. I think that makes it interesting enough for me to think that we should pursue it. Again, I'm not convinced that YAM or any rebasing asset is gonna be used as a collateral anytime soon. I mean, maybe Ample is working on that, and if they get included, then like it's much easier for us to get included. But like, I haven't really heard a ton of whispers.
Supposedly, Ample is really pushing, like in the Aave governance forums, like supposedly, right? One of the more popular topics being discussed is support for Ample.
Cool.
But why couldn't we do our own, Trent?
I mean, yeah, also doing our own is a great idea. But in terms of if we're going to build a full protocol, where is our bang for our buck? I think it's much more in the protection market than the lending market. And so again, I mean, we're talking about priorities. Like the protection protocol is absolutely the number one dev priority, and like we're not going to be diverting those resources for rage quit and lending. The only reason to divert resources for rage quit and lending would be if it's a simpler job and we can use it as a way to kind of release an interim product that lets us go through the motions of a product release and figure out exactly what that process looks like for us as this kind of weird organization, and then have a more streamlined process for the protection protocol. But I'm definitely hearing that like there's some pushback on making this thing a priority, which I think makes total sense. And I think it's something that we should continue to develop and think about, and consider those mechanisms and how we can potentially make this into a much broader thing in the mid to long term. But yeah, the protection protocol is where we're going to be, I think, pushing the most dev resources.
Brock and Nate, could you guys real quick? I mean, if for a lending protocol, like if we wanted to fork like Compound and then kind of add our own spin to it, maybe like focus it on like more elastic finance or something. I mean, what is actually, for those of us who don't code, like what is actually like necessary to make something like that happen? How much heavy lifting is there? What specifically needs to be, adjusted, that sort of thing?
Yeah. So for reference, Chan and I, we were doing a yield optimizer prior to YAM, where I essentially have gone through every single line of code in Compound, DYDX, and Fulcrum. So I am extremely familiar with lending products and those code bases, every single one. So I would say, it wouldn't be, Compound is a little bit more cumbersome, I would say, than DYDX in terms of something like this for Elastic Finance. Their accounting system is a little farther off than what we need. DYDX would probably be a pretty easy system for us to use in that scenario. I've kind of lost track of the original question, besides the fact that it was like, how difficult would it be? And to answer that question specifically, I would not put it at very difficult.
Like what would you need? Like what would you need right now if it was like, hey, this is time for somebody to, or like, this is something we want to do, like, and you're like, okay, cool, but I'm working on YCP right now. But if I had X, or if this many people volunteered, suddenly this becomes feasible, or we could probably realistically start chipping away at this.
I think really ideation is like the actual mechanism design, I would say, is generally the hardest part, right? If I have a clear mechanism where it's very much okay, here is the actual design of the system. Development time doesn't take that long. So if it's highly spec'd out and someone can spec it out where it's like, okay, we need to keep track of this. This is how the math works. Then everything else is super easy. It's the actual definition of here's how the math works that is the slow part most of the time. And so if people are able to think through like, okay, if we have, they can use very easy numbers, but if they are able to do some of the math ahead of time, I'm doing some of the math in my head right now on how this would be done, but that conceptualization, if they can handle that, then it's pretty easy for a dev to step in once they understand the math as well to implement.
And I only ask just because if there is interest from people, in our, the current sort of contributor team, or just again in our community, I just want to make it really clear for people, like, these are the needs. This is what, like, if you want to see this happen, either like find someone who can do this, or if you can do it, like, this is what we need to be contributed to get the ball rolling.
Yeah, and if you can code in Solidity, I highly recommend taking a peek at DYDX and Compound System if this is something that interests you. Most likely we would work primarily off of some sort of fork of those code bases. At the very least, it'll give you a good understanding of kind of how these systems generally work under the hood. And then if you can read their code bases and understand it, then you will probably be able to implement yourself. And I'm happy to give you guidance at any step of the way there in terms of reading or doing some of the mechanism design. Right, as Christopher said, I'm focused on the YCP right now, but that doesn't mean it has to take up 100% of my brain space. I can still devote a little bit of brain space to something else. Just most of my coding time should be spent currently on YCP.
Thanks for indulging that question.
Yeah, I agree 100%, Trent, with the priorities. And I wasn't trying to suggest that anything should be a higher priority than YCP. I was just, but as we were talking about lending, as we were talking about kind of rage quit, that's where I was saying, well, for me, it'd be much more useful if I could collateralize my YAM, borrow against it, and put it to work and do other things that I'm doing, you know, in investing. But if I can only borrow against a very small sliver of the treasury, it's not going to be as helpful. It's not going to be as useful. It's not going to be as good of a product for people who hold YAM as being able to kind of fully borrow against my YAM with a, you know, and anybody can participate. You know, anybody can lend. We could put our own treasury into it as lenders. Obviously, we get a cut of it. Could be a new token, sub-DAO, all that.
Yeah, 100%. I've always loved the money market idea.
John, I think we should go ahead and start to wrap up here.
Yeah, I think so. I think this has been a super productive call. Seems like I really like this structure for the governance calls in the future of the kind of quick rundown and then really just diving into the discussion. I think we've probably made more progress in this group discussion today and fleshed out a lot of more nuanced issues and opinions. So yeah, I think this has been awesome. Hopefully we can continue to get kind of more and more people chiming in on these calls.
And I just want to put out to the community too, if you're watching this and like you think like, oh, this would be a good format to really dig into, you know, specific products or like drill into specific ideas. You know, maybe it's something where we could host more video conversations like this, where more community members can jump on but like just drilling into something specific, right? So like we do a call just for YCP or just for lending. So one topic or one product doesn't kind of monopolize the whole conversation.
Yeah, 100%. I could see next week being a YCP call, and we just jam on that for the whole time. But we'll see how progress goes. Cool. All right, guys. Well, as always, thanks for your contributions and thoughts. Can't do it without you.
Yeah. As a reminder, this call Zoom was posted in the Discord. So if next week you would like to join and contribute in the conversation more directly, that link will be posted again, I believe, next week. So you should feel free to hop in.
All right. Thanks, everybody. We're signing off.
Thanks, guys.
Thanks.